We're gonna launch real quick. Good morning, everyone. First, welcome. Thanks for coming. We got to do something to make finance interesting, which is why we've brought Jim here today.
I would say I tried to draft this in order to be down the middle. So there's going to be some things that people who are the experienced side will be like, well, yeah, of course. And then there's going to be some areas where maybe if you're new at this game, or you're just trying to see what budgeting's about, you're going to be like, well, really, what does that mean? So I say by the end of this, if this is not going to be anything earth shattering, but at the same time, it's hopefully giving everybody a little bit of insight. Maybe there's a few things that you're not doing in your current budgeting process, or if you're starting, maybe there's several of these things that you're not doing. So hopefully you'll take away at least one or two, strong pointers of ways that you can help improve not just the agility, but the depth of information that you're gaining from your budgeting, your planning. I use the term flexible forecasting everywhere I go. I have a rolling forecast. It doesn't stop. It doesn't happen once a year. It happens every month, every week. It may seem like a lot of work to people who do it, but once you get started, it's easy enough. And that way there is no rush at the end of the year to do a one-time budgeting process.
When we, over the course of the past 7 years of Trajectify, we've seen how important mastery of the finances are to each business owner. And so this year we decided to bring a CFO on board to work with us. And Jim and I go back 25 years to Infonautics, where he was the controller and I was the director of engineering. And we've stayed close in touch over the past 25 years as each of us has gone in separate but parallel paths. So Jim today is a CFO, and we look forward to doing more work with him in the coming year. The reason why this year it was so important to focus on finance is because of what happened, right? The pandemic and the economic crisis, and all of a sudden people were in a panic, and some of them for the first time were actually starting to look at cash and saying, oh my, what do I do now? When cash flow forecasting, being more agile around how we plan our finances, being ready for almost anything that might happen is become really critical and rose to the top of the priority list for a lot of business leaders and executives and business owners. So here we are, and Jim, we look forward to your thoughts on how to stay on top of our financials by looking ahead and being agile. So thanks for joining us, Jim.
Okay,
Floor's yours.
Let me again. My name's Jim McMonagle. Here's my email address, and here's today's date, in case there's any time travelers out there. This is where we are. What I'd like to start with our goals. So our goals for today, or for this next half hour to an hour, is to provide some practical and agile financial steps where you can use during your budgeting process, or creating, if you decide to create a flexible forecast. I promised, or at least I'm attempting to avoid excessive accounting detail and terminology. So if someone is new to accounting and sees a word you're not familiar with, or some sort of concept, please bring it up. And likewise, if you're an old hat at this and it's kind of beneath you, well, I'm trying to be down the middle of the road here. So just kind of take that as it is, and hopefully I can give you some pieces of information that will be useful to you. And yes, offering options to consider. So by the end of this, you will maybe think about one or two things that will be an impact to helping you understand or take a better or faster look at your plot process. It's not a training on how to budget. I put 8 steps, the last step being Q&A, but really Q&A we can happen at any time. The logic behind this is to what kind of, I call it maybe a mind frame or mindset you want to have in as you're looking at your budgeting, your flexible forecasting. Create a high level view. That's fairly standard, and I'm hoping if you're not doing it, you should stop and take a high level view at all your numbers, and I'll show you an example in a minute. Here's a few useful KPIs we'll discuss. Then you address it really by the type of activity. Number one is the cash inflows, of course, sales, but not just the sales, the actual receipts when that happens. So make sure that you have a tie from your inflows, your sales to your inflows, and make sure they're tied, and make sure that it is understandable, because the timing differences can make a difference in sometimes making payroll. The payments for taxes and fixed assets. That's another aspect. It's not necessarily a fixed or a variable cost. Taxes can be random. It can happen throughout the year, and you just need to be aware of them. Variable costs. So that in my world, it's not necessarily COGS, as in cost of goods sold, but it's really anything that is tied to the sales. So that would vary. So this type of analysis of an understanding of a variable cost is really tied, has connections to how much you sell, quantity, dollar wise, and then ensures that there is a connection, so that if there is a change in your estimate for certain, let's say you sell retail and you decide to sell to businesses, there's going to be a difference in the timing of the collections. There's going to be a difference in the cost. Maybe you're making a delivery, and the delivery costs would change. So those things need to be taken into account. So this hopefully gives you the tools that you can make such changes and prepare for that. Fixed costs are just that, things that happen to just about anybody. So whether it's rent, legal, insurance, and business supplies, those are all fixed, and sometimes they're tougher to forecast. Like a rent is easy enough to estimate, but your business supplies, your maybe your daily postage for just random mailings, that can be more difficult. Marketing costs could be variable, it could be fixed. It depends on how you approach your business. So those are things that, again, just being flexible. I can't address it for everybody here, but again, at the end of this whole thing, if there's questions that we want to get into, how should we do our marketing costs, we would have to discuss your business. So, and again, I give my email address for if you have any questions, I'm happy to follow up with you. And then Q&A throughout the process or the presentation. So the logic, as I said, is more or less what your mindset is as you're going into this whole process. Your number one is to minimize the downside of what happens with your cash, and then to maximize the upside. Sounds like it's kind of, yeah, that's obvious, but sometimes people just go into budgeting as if, well, it's just a process. I have to do it and I want to get it done. But really, you want to think, all right, how can I minimize the downside? Downside being not only low cash, but the downside could be, what if another pandemic, or things get worse in the pandemic era? I mean, I'm just being honest with yourself. If things slow down more, how do you minimize the downside? And then that's just an actual discussion that you should have with everybody on your team. In this presentation, I say cash is king, meaning there are other reasons for budgeting. There are other reasons to operate your business, to provide for your family, to build a big eggshell at a retirement, to build a practice that you can sell to another company. But right now, I'm just focusing on cash, to develop a way that you can ensure that you keep your full cash, or your maximum cash in there. I don't get into investments. I know some companies have investments. I've talked to clients that say, I have this excess money, I'm never going to use it. Should I pay off my loan? Should I hold on to it? What should I do? So there's things like that. If you have excess cash, you can invest it, you can pay off debt. And those are all, individual decisions that should be considered. And what I say in the logic of extra effort now is really that there may be a little bit of extra work putting together some of this information, but its goal is to provide security, to ensure that you are secure. You can sleep at nights, you can make that payroll. And that's the number one thing I hear is people saying, how am I going to make payroll? And the other thing is that a lot of entrepreneurs say to non-entrepreneurs, you've never made a payroll, you've never worried about a payroll. So hopefully this will help you worry less about making that payroll. And then the question comes up, who's responsible for reconciling bank accounts, analyzing the spending, collections, and making payments? And it's really, you as the business owner. You may have hired a person to do that, but at the end of the day, you are responsible for making sure that person does their jobs. So it's just a matter of being personally responsible for the company, not just individual work and functions, but the whole company. When you are doing your budgeting, your forecasting, planning, you want to involve the key people who are data gathering. Give them a sense of accomplishment, that they've contributed to something. I think that helps tremendously with their willingness to contribute, and they often will contribute even more by being involved. Likewise, involve the key decision makers. If you're not the only decision maker in your company, involve them in the budgeting process and let them know, here's what you're thinking, here are the goals, and here are the outcomes, and let them make some really contributions to the process. I like to use a Gantt chart, just use Excel, but a Gantt, turn it into a Gantt chart, because not everything happens sequentially. You have to do certain things at the same time. It would just take forever for you to do things sequentially. So a Gantt chart really helps you organize it, sets your goals for start, for end dates. A lot of things like the sales and the variable costs are tied together. So you have to get the sales started first, but you want to be able to prepare the variable costs at the same time. So in the logic, we have, I'd say, 8 different steps in your logic. So you start with a high level view we've discussed, and I have a sample of our high level view. A 13-week forecast. That's, I think, a little bit less normal, using a 13-week. And what that really means is your next 3 months, break it down into weeklies. You're going to see the ins and the outs. There's going to be times where a midweek of a month, your cash could be low, it could be extra high, and you want to make a decision based on that number. You don't want to look at month to month. Month to month over the next 3 months is limited, and there are a lot of data that's available in your financials if you are looking at it more closely. Identify your major customers or segments. Identify your major vendors. So it's the matter of the ins and the outs. A major customer can have a tremendous impact on your inflows, and a major vendor will have a tremendous inflow on your outflows. So you want to be able to know what they're doing, how fast are you paying, how fast are you receiving, and make decisions appropriately. Excuse me. Don't be fooled by float. That's really just your bank float. If you're writing a checks, those checks may be uncashed for a day or 2 or 3, depending on, obviously technology today makes your payments, your float, smaller than ever. But if you're still using checks to pay your vendors, you're going to have float. Is it good? Is it bad? No, it's just there. And you're going to want to be able to understand where your bank balance is, understand where your book balance is, and react appropriately. Because you have, like I said, timing of vendor payments. So number one is, if a vendor offers you 30-day terms, do you take it? Not everybody takes 30-day terms. They sometimes feel like they want to be in good graces with their vendors, which is great. Not discouraging it, but it's important to consider all of your options in this case. Bank credit, same thing. Are you with a bank? Have you discussed with the bank whether you can obtain a line of credit, a term loan? Those little things can help make a difference. And especially if you have dips and valleys in some cash balances, you want to have that as a backstop. So if you don't have a bank relationship in terms of a lender, then you should probably consider doing that early in this the new year. And then understanding insurance coverage. So everybody's probably has some sort of business interruption, as well as other liability insurance. You just want to review that and make sure that any crazy times with any new pandemics or any shutdowns are going to where your insurance coverage will kick in. Okay, next page on the high level view. We have a purely hypothetical situation where it's weeks 1 to 4 and then week 13, and then just showing months 4, 5, and 6. So as I said, I would start with a 13-week. The next 3 months turns into a 13-week forecast. And the reason for that is, in the high level view, is have your beginning cash balance, total collections, total inflows, total outflows, and your ending cash balance down here. In this sample, a mid-month ending cash balance could actually turn negative, but the ending month could bounce back. So if you are only purely looking at it from beginning cash balance to ending cash balance of the month, you may say, "Oh, I'm fine." But in the middle of all this, you may have an issue that you don't want to have an overdraft on the bank account. So this high level view gives you a better look at things like that making sure that, well, wait, what am I doing? Am I spending too much on equipment? Do I need to defer this equipment purchase for a week, for a month? Until you see it in this detail, you really are not able to make that informed decision. And then trust me, I've been in those situations where My month-to-month forecast is fine, but in a midweek, when it was, like I said, meeting a payroll, you had a sudden emergency. And going back to the previous page where I said, this is really just a security. You want to have the security that your bank's not going to be causing problems or issues, and you're not going to have a problem making payroll. Granted, you may have plenty of money at the end of the month, but if a mid-month you don't have enough money, the payroll sometimes is an issue. Here's what your cash in the bank is, and here at the bottom is where the float is. So as I said, float is the number of checks that could be outstanding before hitting the bank. And if you're looking at purely at your bank balance, you say, well, I have this much money in the bank. Great, but you've really committed to be making more payments. So the float is money that's been committed, it just hasn't hit the bank yet. So you really want to be making your decisions on the ending cash balance and not on the cash in the bank. They're generally getting closer, like I said, because of technology, but these days, you just want to have the full firm understanding of the cash. And then, all right, so following pages, I'll have more samples that will tie into this high level view. But this is where, if I were CEO of, a distributor of coffee beans, I would want to know all of these going in. I would want to know what my weekly balance is, what I expect to come in and what I expect to go out, and then match that up every week to make sure that we're on target. This gives me the chance to really quickly adjust my planning to make, whether it's a small, decision on timing, or whether it's a change in vendor, or whether it's another major decision on how you're going to operate your business. The weekly gives you that much more of a chance to react quickly and make any appropriate changes. All right, page 7. Here's some KPIs. And again, these are just a few that I could fit on a page. So we have cash APIs, target cash. Target cash is just that, where do you want to be your cash? You have a target of 1 month of payables, 2 months, 3 months of payables. It's something that's tied into your understanding of your insurance. If you have a business interruption and your insurance takes a month before it starts paying out, do you want at least 1 month? Do you want 2 months to have, and just in case something else goes on? So again, industry by industry, but you want to manage you have an idea of what your target cash is. Number of months in cash, very similar to that target cash, but it's really, it's of a ratio that says your target, your actual cash balance is based on 2.5 months, 3 months of future cash. And it's more of a ratio rather than just a dollar amount. And then the ratio of inflows to outflows. So every month you want to have an understanding of your inflows is X, your outflows are Y. You want to have a good understanding of every month, so that on a trend basis, you can understand that your ratio of inflows is going better, worse, and identify any differences from just looking at one ratio. Basically, a 1-to-1 ratio would mean you're equal payments in and payments out. And again, it's on the cash basis, not on an accrual accounting basis. And then we have receivables and payables and bank KPIs here. So I'll try to touch on them briefly. AR days. I'm not sure how many companies do this. So AR days is you actually look at a specific customer and you see how many days it takes them to pay. You can then take a weighted average of your customers. And I have an example on the next page. You have a weighted average of your customers' payments coming in, and it gives you a better idea. Do you need to work harder on collections? Or is your collections okay? Where are you at risk? Payables has a similar ratio for payments days to pay. So if you think, oh, most of my vendors are 30-day payments, and then you come look at your payment actual days and you're making payments in 10 days, you either have to have a discussion with the person making the payments, or you have to take more advantage, or your understanding of the vendor's 30-day terms is just not correct. So there's an understanding of the business and the understanding of the inner workings versus the actual what's happening. So that's an important thing for payables. And then down here, bank KPIs. If you happen to have a bank loan or are thinking about one, some of the KPIs or what ratios or covenants that are called in a bank loan would come up would be a debt service coverage, a debt to equity, or tangible net worth ratio. So these are all important if you start going down the banking line for future banking, for future operations. Okay. My next slide is on the cash inflows. So as a part of our initial setup, we were saying we would want to look at cash inflows on our own they are going to be linked to sales. You would want a 13-week picture of your inflows, and then a 9-month forecast. And what I said I like to do is keep it rolling. So as 3-4 weeks roll off at the beginning, as you actually create them, you're going to want to create the next thing so that you have at least a full 12 months picture in front of you. Identify your major customers for your inflows, and whether it's 5%, 10%, any more than 10% is definitely a major customer, and you should be fully aware of their operations in terms of how they're ordering, how much they're ordering, when they're paying. Those are all important things. And then their customer trends history. So this will give you an idea of the customer. Are they having a potential risk that you need to be aware of? Is there an industry issue? Is there a supply issue? Those are all important things that you want to start. And starting with the high level will at least give you that idea that you're watching it on a high level, and then you can drill down quickly if you have the information in front of you. Next page. Okay, so here's two things: a sample of inflows, very simple sample, and then a sample of days to collect calculations. So on this inflows detail, like I said, you would tie in your sales to your collections. So whereas most people budget based on here are the sales, but if you don't collect it in the same period at the same speed as some versus other, you really need to differentiate the two. They can stay together. You can have a customer A who makes a sale here at the first week of the month, and they're going to pay in the first week of the month. That's great. That's where it takes you maybe up to 7 days to pay. Customer B, their sale is in the first week, but in the second week is the collection. And then these other customers, let's say we're aggregating a 10 and a 25,000 throughout the next thing. So is there a question that we want to address this?
All right. Marcia's just making a comment. You're good.
Oh, okay. All right. So anyway, this type of view, by tying in your sales to your collections, will give you both what you need. You need to accrue. You need to have accrual accounting. Well, generally you do. Not everybody does, but generally, companies like to have their accrual accounting, their sales, to match their actual activity. But when you're getting down and you're trying to be more agile, you want to say, all right, well, really, what's the collection? Down here on the days to collect, this would be a sample of how this days to collect works out. So in this customer A, where they made a $20 payment, it took them 6 days. So we just did the simple math, and then you do a weighted average out here. So you can say, all right, this customer A pays in 6 days. Well, if your actuality, they come and pay in 31 days, maybe you want to look into it, or maybe it's fine. Maybe you don't know, but so it's just something to raise your awareness. The weighted average here of 18.1, that would be the overall company's weighted average days to pay, which are actually pretty good. I mean, I don't know anybody. This assumes that you get 100% of your collections within 30 days. That's rare. And what you would end up finding out is maybe customer D is going to have a 40 or 50 day payment cycle, which, all right, you can live with that once, but if that starts building up, you know what happens to that. That's going to really be a drag on your cash. So those customers that are not only long, but getting longer are two things that you need to look at this analysis. Inflows, there we go, taxes. I put taxes in the middle because it's an unusual thing that it's not just a normal flow. And really, taxes and fixed assets are taxes. Number one, you don't have a choice as to when you pay it. Fixed assets, often you do have a choice of whether you buy it or not buy it. But taxes, all I can say is always track your tax payments, your due dates, and your estimated amounts. You will really regret having a tax bill that's due. Maybe you had a good year and you want to be able to put money away for the tax bill that's going to be due usually on April 15th. So you want to have a good, just really a schedule of what the tax payments are going to be. Building an internal cash reserve is a good thing to have. I know people don't necessarily put it into money into a savings account anymore, but you want to have it built into your analysis that you have to pay these liabilities. And taxes are one thing. Fixed assets are another thing that you're going to potentially build up a liability for. If it's a necessary fixed asset purchase, let's say for hiring, if you're hiring, that's great. You're adding people. But you want to make sure you include fixed costs that you're going to be incurring. Companies, I would say, often defer fixed asset spending in lean times, and the reason is that sometimes a fixed asset can be deferred. So you don't want to make, you want to make sure that you don't sacrifice another expense at the expense of buying a fixed asset. So you don't want to. So it's always a decision. This is not an answer to your question. This is another question that you should be asking yourself. Do we defer this fixed asset purchase? Will it add more value at the end? Or will, by deferring it, will I be able to add more value at this point by whether it's hiring a person or doing another use of that asset? So it's just another decision point. And unfortunately, every case is different, whether you're a manufacturer or a distributor or just a service company. Every situation needs its own analysis. Variable costs are just that. They vary based on either the sales quantity, the sales dollar amount, and they are this schedule, this understanding, it should be linked to your sales. So as you make changes in your business model, you are automatically reviewing. And of course, I'm talking, let's using Excel. Not everybody uses Excel, and I can have many discussions as to whether accounting software is an adequate use for budgeting. I'd say a lot of times there is good accounting software for budgeting, but does it do the agile cash planning that we need? That's another question. So I typically defer to or go to an Excel spreadsheet to manage these operational cash questions. So the variable costs linking to sales, for example, inventory. There is payroll in manufacturing and distribution or service businesses that is going to be variable. And delivery costs are also variable. And credit card fees are variable. So I mentioned COGS versus variable costs. So COGS are cost to create a good, but in the accounting world, the credit card and processing fee is not necessarily a cost of goods sold. And I've had discussions with people over the years who have questioned that, and they said, well, it's a cost that goes into it, it's variable. So just because something is variable doesn't mean in the accounting world that it's specifically a cost of goods sold. For this analysis purpose, I wouldn't even worry about calling it cost of goods sold. It's a variable cost because in the accounting world, some costs will be accounted for as a COGS and some will be called marketing. Credit cards and processing fees have typically in companies that I've been in been called marketing costs. So even though they do vary based on your sales. So that's just one of those accounting lingo things that that people should be aware of. Here's a quick sample of a variable spending schedule. So this would be tied to your sales. So if you're able to make a sale, you would have a variable spending. And this here we see, oh, it's payroll. This is assuming that payroll is every 2 weeks. And the assumption here is right here, the payroll in week 2 and in week 4, that the outflow is at the same time. And I think anybody running a business does understand that you do not move payroll off of the day that it's due. If you do, you probably have other problems that you probably could use some assistance with sooner than later. So anything like payroll and payroll taxes are always a really, I hate to say it's a non-discussion item, but it's a non-discussion item. That's got to be your first thing, is to make sure payroll and payroll taxes are kept up on time. Inventory is another question. So in my example, let's say you're a coffee bean distributor. You can buy inventory, and as I say here, right here, and in this sample, you're actually paying for it right away. And at this point, if you as a business manager would look at it and say, well, why don't we get 30-day terms with this supplier? And that's a great question. This type of a weekly view would give you the opportunity to make that question. If you're looking at it on a monthly view and you say, all right, we pay we buy $10,000 of inventory a month, and you see payments of $10,000 of inventory a month, you're assuming that, okay, well, maybe I'm taking advantage of these 30-day terms, but maybe in actuality, you're just paying it right away and you're not getting any advantage. So the advantage comes in the fact that when you take payment terms and you can extend it to 30 days, you have a receivable terms and you can potentially speed that up. It gives you more cash today to do things that you need to do. So when you have that the decision, you have to make that decision on acquiring some fixed assets, you won't have to make your sacrifice because of these other areas. And these two other areas do add up to enough to give you that ability to buy that fixed asset. So if you're let's say you're in that delivery business and you are needing new delivery equipment or new delivery, maybe you have to have a special refrigerator, you're not going to have to sacrifice that because you've let your vendors get paid right away and your customers you've let go paying you whenever they want. So it's one of those things that, you want good relationships with, and I've known business owners that are like, well, I want good relationships with my vendors. And feel like, well, do they want good relationship with you? Because they're not giving you the kind of the respect that you're giving them. So it's one of those things. And not that I hate to use the word respect, but I think, respect needs to be brought into some of these conversations with your vendors, as well as your customers. And the delivery costs. So here on this very, very simple schedule, you would see that everyone's getting paid right away, or at least you would assume that. And you'd want to ask that question as to delivery costs, as to inventory purchases, and any other variable spending outside of payroll. Are we taking advantage of the ability of any terms? And if we're not given terms, maybe it's time you ask those questions of your vendors. The fixed costs, just that those are fixed, not tied to your sales, and it's necessary to run your business. So of course, you will have a payroll cost. Other samples are rent, utilities, professional fees, and I always think of legal, and then let's say insurance. Now your insurance costs, and I've talked to that earlier, you should have basically, I'm hoping you're financing your insurance. Not that I'm hoping, but you probably, if you have enough cash to pay it up front, they do request your upfront payment. Financing is an option that I've utilized in companies where the cash month to month was enough on a monthly basis, but not at the beginning of your anniversary term with your insurance company to pay for it then. And that gives you a nice predictable cash outflow. So I think predictability is good. But yeah, by all means, if you have the ability to not finance your insurance payments, go ahead and do that. It's always good to have fewer liabilities as you're thinking of other options for your business. So those are predictable. Rent, one thing I would say, I'll jump to the next screen. Rent is, how do I put it? They have, I don't want to sound like you're trying to pull one over on your landlord, but if you have a rent and you have a 4-day grace period, think about taking that grace period. I don't know why. So number one, and if you have a separate accounting department, I know as a fact, your accounting department wants to get that bill paid right as soon as possible. They know that it's owed. They don't want to have to deal with a landlord who hasn't gotten paid. They're going to pay that early. You as the business manager, as the cash flow manager, want to have a discussion with that accounting person that says, it really behooves the company to not only not pay it before the first of the month, but really see where the grace period takes you. It's a little bit of a change in mindset, and talking about mindset for budgeting. I think sometimes accountants need a change of mindset so that they're operating as business people and not as people trying to push as many papers across their desk as possible. And then these days, I know paper's a passé term, but that's the message that would, I guess you would glean from this thing is you would see that, all right, we're making payments right away, and maybe they're not due right away. Maybe they need to be managed more closely. Insurance is predictable. If you have it financed, they often give you terms as well. So make sure you're taking advantage of insurance terms. Legal's the other the other one that, you know, I've never been able to guess, to predict what the legal bills are going to be for a year. So it's almost a useless practice to try to budget for a full year. You do it anyway, but you want to at least have your next 13 weeks, because, you know, if you're involved in any legal issues or have legal counsel for whatever reason, you're going to know what's going on in the next 13, in the next 8 weeks. You're gonna say, all right, they've done X, Y, and Z for us, and those lawyers' bills are $600-700 an hour. So you're gonna want to be on top of your legal bills for that reason. If you know a lawyer that's not $600-700 an hour, send me an email, and I'd like to talk to them. And days to pay. So the days to pay is kind of the same calculation. It is the same calculation as the accounts receivable days to receive, but it gives you an idea of how quickly you're paying your vendors. And like we said, let's use those terms for payment to the full extent. And, you know, and at the end of the day, you're running your business. If you say, I can pay my law firm in 45 days, but they're doing such a great job for me now, and I don't want them to get distracted by my longer payment terms, then by all means, it's your business. You have to run it the way you see fit. You know, these are just ways, ideas, concepts that you should be considering. So maybe it's not your law firm, but insurance. Again, you make sure you pay your insurance, but, you know, does it need to be paid on the day one, or is there a term associated with that invoice payment? So you want to have all those understood. And whether you do all your vendors or just a few is up to you. You can't get the weighted average of the full payment unless you do each one separately. That's kind of the challenge. But if you have any person who's able to do your detail, your day-to-day, they should be able to run information that gives you this, and then getting an understanding of the trend as to what happens over the time frame, the last year, the last several months. This will drive your estimated collections. So or estimated payments. So if one of your vendors you've been paying on 20 days and you say, oh, I'm going to use the 30 days, you would put that in your forecast, and then you would make sure that your accounting team sticks to that payment schedule. So that's where that drives your day-to-day decision making. All right, so good. So in summary, yeah, so we had these areas, we had a kind of a logic as to what's going on in your creation of your flexible forecast here. You have your cash inflows, which you understand will be tied to your sales, but not necessarily the same thing. Variable costs and fixed costs. Taxes are separate. Fixed asset purchases are separate. You want to have them outside of your operating costs as a spend number, so that you can understand where these ebbs and flows may come, and make decisions appropriate on that. Understand who your critical customers and your critical vendors are. Again, just for that reason, if you can improve the collections from your critical customers, that's going to have not just a one-time effect, but a dramatic effect that rolls up over the next several months. And same thing for paying vendors. Taking full advantage of the payment terms will make a difference, excuse me, on your cash balance. Gives you the opportunity to then make your decisions on your better decisions, more favorable to you on your operations, such as making a fixed asset purchase, or you know, sometimes it's even hiring an administrative assistant if you're a very busy executive who needs some assistance with a number of different areas. So thank you. That's
super. So if I could just make a couple of observations, you know, so what I got out of that was, you know, let's break up our forecast into 13 weeks. And as business leaders, we really need to focus on cash. You know, a lot of us have our P&Ls that, you know, on accrual basis that match the type of business we are, whether we're a service provider, whether we're a SaaS company. And we may have other business metrics that we're looking at: cost to acquire customers, cost to service customers. But you know, what we heard today, or at least what I heard today, was you know, especially in times of uncertainty, you need to focus. There has to be a strong focus on your cash flows.
Exactly.
The other thing that I'm gathering from this, because there was a lot of information in this, is that we're not expecting business leaders to do this caliber of work. Maybe let's arm them with some of the questions, but it's their accountant or their CFO who really needs to present this data to them.
Yeah, there's a lot of data that needs to get done or understood. And if one or two of these areas kind of resonated with you, or you ask, the business owner asks, what to you said the accountant or whomever is running your books, are you doing this? Are you doing that? And get that discussion started.
One of the questions we hear often is about operating reserves. Do you have any? Is there a blanket recommendation for how much operating reserves we should have, put aside?
I have used a 2-month operating reserve in real estate, whereas we thought, what's the worst that could happen in terms of business interruption with customers not paying? And so that was a kind of a rule, not even a rule of thumb, just how the wind was blowing. But you want to take into consideration what insurance would cover, other backstops such as bank loans. Some people used a line of credit as their cash. They said, well, we have this amount of line of credit, so if we have to, we would just use that, and they really had no reserve at all. Other companies, have hundreds of thousands of dollars of reserves. And in fact, one of my clients was just asking me 2 months ago, I have extra 300,000 of cash reserves I'm not going to use through the summer or the winter because he has a low employment during the winter. And he's like, should I pay off my debt that's not terribly high rate, or do we invest it in something? And I said, well, where's it going? Where do you think the investments are going? So it was one of those decisions. That was rare. He paid off his debt, and that was just another way to use it. He had availability of a line of credit, and he was going to said if he had to tap it, he would. Otherwise, he was just going to hunker down with lower debt over the winter.
So given, having 2 months of capital reserve with your real estate company at the beginning of the year might have seemed like a safe, until you realize that, if your real estate company, in this example, that maybe my tenants aren't going to pay till the end of the year, right? Maybe the city has protected them in a way that, protected tenants. And now I've got some pretty big cash flow issues. So one of the things that we're seeing is people keeping more and more, higher capital reserves, as many as going from 2 to 3 months to closer to 6 months.
Yeah, and then that the client of mine who paid off his loan actually owned his property, so he was not even renting. So, but yeah, and things like, whether you're paying rent or receiving rent, it makes a difference. But yeah, if you're receiving something that could be impacted by a lot of other political forces and other forces that are outside of your control, you may want to start thinking about increasing that reserve.
And relying on the line of credit is good as long as the bank extends that line of credit, keeps that line of credit alive if there's ever a credit crisis, which is one of the things that could follow in a recession, for example.
Mm-hmm.
There's you may not be able to rely on that credit being available even if it's already been pre-approved.
Oh yeah, definitely. And that's why I said keep in touch with your a banker. If you don't have that line of credit, go contact them, and they're more than happy to. Anybody here from the banking world, I'm not sure, but they're more than happy to talk to you about establishing business relationships. But just don't let them sell you what you don't want. Yeah.
But I think one of the things we saw early on in this pandemic is business leaders, as they were trying to consider the PPP program for their business, realized how good or not good of a relationship they had with a banker. So I think that was a quick lesson learned, right? Let's get a good relationship with a banker. Unfortunately, a lot of business owners may have not acted upon that yet, but there's still plenty of time. So we still encourage people to have a good relationship, to have a strong relationship with a bank.
Yeah, I don't think any banks are turning businesses away at this point.
Just something. And always happy to, reach out to us on the side, one-on-one. We're happy to answer any sort of finance or any of the other coaches regarding organizational development or people and processes and and product, we're always happy to be available to chat with you. We thank everyone for coming this morning.
Yeah,
And
thank you very much.
yeah, have a safe Thanksgiving, everyone.